Looks like my volume might be a little low. Just let me know if you're hearing me okay. All right, I'll turn it up a bit. Hold on. There we go. Let's see if that's better. Okay, just real quick, I got the Facebook chart up here. This is the 5-minute, just watching it here. I kept a small position going into the close here. I'm not going to really get into the whys about that right now. We're going to do the tutorial, but at least we got something here popping on earnings. Also, want to just mention here, if you take a look at the bullish advisors numbers, I'm going to just zoom up here. You can see we went over the 3-to-1 level. We're at actually almost 3.2 to 1. And this is getting very very frothy as far as this sentiment number. You can go back, and this is a level at which you don't usually have a whole lot more upside. If you do, you should use it for selling. Also, if you move down here, you'll see that the bears are down. They're way down to that historic low number. So this just tells you that there's very few people that are bearish, and the bulls to bears are at a ratio that historically has not led to big moves in the stock market from that point forward. Also, the blogger sentiment has picked up this week. The bears are down to about 18%. So there's really very few bears out there as far as what people are saying and writing about. When we look at the RIDEX asset ratio, and that's what people do with their money, that also went up this week, and we're very close to the level that was the peak before. So I'd be real careful here. And as you can see, we've been up 12 or 13 days out of 15 days in the S&P. The Dow's gone up 1,000 points in 16 days, and it's hitting that upper range where it's been pulling back from before. And also, the main thing is we haven't seen many stocks do very well. We're not really had a big loss in our trading. It's a very small single-digit loss, just of a few percent, but there really hasn't been any upside. And I'm seeing some key market leaders starting to roll over here. LinkedIn today, of course, was down almost 10%. So you have to be a little careful here. Okay, let's get into position sizing. So we're going to do a tutorial today on position sizing. There's a few key risk factors that you need to consider whenever you get into a stock and when you're considering how you position into a stock. The first thing is the liquidity of it. For some of you, that may not be a problem at all. You might be trading a small number of shares that it doesn't really matter about the liquidity. If you're trading 500 or 1,000 shares, you could trade just about any name. There's very few names that you wouldn't be able to trade. However, if you're needed to buy 10 or 20,000 or more shares, that liquidity becomes a factor. You're not going to want to go and buy 15 or 20,000 shares of a stock that trades 25,000 shares a day. So that would be a factor. I tend to think that a rule of about 10 to 20% of the daily volume is a decent rule of thumb. The other thing that's important is the volatility. If a name is real volatile and it's whipping all over the place, well, again, you really have to try to account for that, and you're not going to want to take big risks in stocks that are whipping all over the place. The next thing is your stop loss, where you can put an effective stop loss, either based on technicals or if you're just using a percentage stop loss. And again, if you have a very volatile situation, it's going to be very difficult for you to put a stop loss in there that's tight and not get it hit, because the price is moving back and forth very wildly. So that's another reason why we wait for that volatility to contract to be able to get those entry points that are not only very specific as far as getting a trigger, but also to give us an idea of when the stock is not acting right and you're getting that volatility to expand and not at a big cost. We don't want a big cost to know that a stock's acting wrong or not acting correctly. So we want to keep those ranges very tight. Now, of course, there's general market risk. If you're in a bear market and things are not looking very good on an overall market, you want to take that into account also. And then what we just experienced in some names recently, of course, LOCK, we got knocked out of it. It was believe it or not, it was another one that I almost held into earnings, but it really would have been taking, I think I would have been being unfair to you, and maybe even to myself, if I held that, because it was a smaller company, and that's a situation that really could implode if things go wrong. The Facebook is a little more stable, and I even thought even if they did miss that, you'd probably come down, undercut to 50, and probably get a rally back that would get you out. Not too bad. So earnings or holding overnight is another risk, and then there's what I call the crowded trade or efficient pricing risk. What you want to get involved in are stocks that are inefficiently priced. And what that means is that all the information isn't known and it's not very obvious. Even though stock may be making a new high, may have great earnings on the table, and there may be a lot of people that know about it, but it just isn't at the point where it's virtually everybody knows about it. And something like an Apple, where once that stock went up and up and up, it was up 7, 8, 10,000%. You know, it was pretty much everybody was owning Apple, and it was a crowded trade. Netflix recently, I talked about how I thought that was getting to be crowded. Some of these names where when they get crowded, there's risk involved. The risk isn't necessarily that the stock is going to implode on you, well, which it could, but because once you're crowded, you do have a lot of people in there, and it's a potential for selling. But the real risk when you have a crowded trade and it's efficiently priced is that it tends to be random, and it tends to go back and forth, and you don't really get trending where you can get in there and buy at a point and then ride a trend up and, of course, get off the elevator and make a profit. You'll whip back and forth, and there's just a high risk of getting stopped out. So these are the factors that need to be considered. Now, I keep things pretty simple when it comes to position sizing. I keep things pretty simple, and I'm going to go over that. And I think I got one slide that I left out just looking through the slides, and I might have to go and pull a slide back in here at the end. So just, Bob, if you can remind me of that. When I'm entering the market, I'm going to start from entering the market from a cash position. Okay, because at some point you'll be put into 100% cash, and you'll get stopped out of your positions or take a bunch of profits and get into cash, and maybe you're having a market correction, and at some point you will go back into the market. At that point, I'm usually going in with pilot buys, which would either mean that they're smaller than normal buys, or I would just go in with maybe one purchase and see how that works out, and I wouldn't bump that trading size until I saw some trades working. So the real key is that you don't want to raise your exposure very much unless you're seeing some type of traction. And this whole position sizing and pyramiding tutorial, I think, is really one of the very key elements in doing really well in trading stocks. Of course, you have to cut your losses, and that's the number one most important thing, is that you keep the losses small. But you could get cut up quite a bit and cut your losses over and over and over and get what they call death by 1,000 cuts. So just because you're cutting your losses doesn't mean that you can't suffer a big loss. You could. The way around that, and the question that I'm asked very often is, well, how do you not suffer getting stopped out over and over and over? Well, you really can't control whether you get stopped out over and over and over again, but you can control how you respond to it. And if I'm not doing good at 25% invested, I'm not going to 50. And if I'm not doing good at 50, I'm not going to 75 or 100. I'm certainly not going on margin if I'm not doing well with my smaller exposure. So generally what I'll do is I'll buy one stock, and maybe I'll take a quarter of what I normally would take. If I normally take a 25% position, I might only take a 6 1/4, maybe a 5% position, or a half position, 12.5% or 10% position. If I win on this trade, and I'm just using simple numbers here. If you're at a 2-to-1 and you're taking a 4% stop, and it's a $250 risk, and you make 500, you now can move into that next trade and double your size and finance your risk, because now you've banked 500. So over here now, when you move up to the larger position size, you're now doubling your risk, of course, because you've doubled your size to $500. But you've just made $500. And if you can get 2 winning trades, you can move all the way up here and move up to 25% position. And even if you lose on that trade, you're going to still have $500 in the bank, right? So when I'm ramping up exposure, here's what I'm generally going to do. It's one of two things. I'm either going to take, I think of it sort of as my 4 core slots. So the most that I want to be concentrated is 25% positions. You don't want to get more than that. You could go up to 50. If you have a smaller account, you're really on top of it, but it may be 4 positions full margin. That's how I was aggressive when I had a $50,000 or $100,000 account. I was that aggressive then. But at this point now, I'm generally getting most of my money when I'm really, really aggressive into 4, 5, 6 names. So I think of it as basically 4 big slots. And I might start off with 4 quarter positions, which would be the same thing as if I took 1 full position. So let's say this is a 25% position, and 4 of them would equal 100%. Well, if I take 4 quarter positions, it's the same exact thing. So if I took these 4 quarter positions, and let's just say I set a 5% stop on each one of them, that's the exact same loss if I set a 5% stop on one 25% position. It doesn't matter. Again, if you drive from California to New York, whether you go straight through or you stop and go, it takes the same amount of gas. It's the same thing with position sizing. Now, if this works out and I start getting some traction, then I move up and I might step up to either a second position or what would be essentially the same thing as an exposure, 50% invested. Maybe this time, instead of having the 4 quarter positions, I add 2 half positions. So now I have 6 positions, but 2 of them are a little bit larger. Or, like I said, if I'm a little more aggressive, I might just add a second position. But either way, I'm not really bringing my exposure up very much without having those backlog profits. Now, first of all, by doing this, each gain finances 2 losses if you're operating at a 2-to-1. If you can average 2 times your losses on your gains, you could be wrong 2 times and only right 1 time, and you're not going to get in any trouble. So that's why it's really important to maintain that ratio. So remember, trading is not an on or off business. You don't just go all in or all out. You scale. You don't have to. It's unnecessary to make big, quick bets in the market. You have plenty of time. If the market's bottoming, you want to make sure. Sometimes you're right on your analysis, but you may not be dead right on your timing. You're fundamentally right, but sometimes the timing is a little off, and it takes time to get yourself positioned. So you want to have small successes lead to your bigger successes, and let the winning trades finance the larger trades, the smaller. And again, if you're losing, I'll just use hypothetically $500, but you're gaining $1,000 on average, you're able to now finance a few more trades with just 1 win if you keep that ratio a 2-to-1. So when you're doing really well, you want to scale up, and when you're not doing well, you want to scale back down. Now, we had a question asking, well, how do you know which stock to buy first, and how do you choose which ones to go into? Well, the first rule that I have is I try not to have favorites, because my opinion is usually not nearly as correct as that of the market itself. So what I do is, as the stocks start to set up, and maybe we're in a market correction, and I see stocks setting up, I'm now going to just mark the pivot points and mark the spots at which, if they breach that point, I'm a buyer. And then the first ones that break out or move through the pivots or move through the pullback buy, whichever I'm trying to institute at the time, those stocks I just buy in first in order of breakout. So if a few of them break out, I might take 1 or 2 names. And I'm not going to keep adding positions if those positions stop me out. For instance, if I add 1 or 2 and I get stopped out of both of them, I'm not going to just rush into 2 or 3 more positions. I might take 1 more position, and if that knocks me out, then if I do take another position, it'll definitely be at a smaller size. I'll take my size down, and if that stops me out, I'll take my size down again until I get stopped out 5, 6, 7 times in a row. I know something's wrong with the market. The timing's not right, and I'll probably just back off completely for a little while. And take a look and make sure what's going on in the general market. So you don't want to keep trading even the same size if you keep getting stopped out. You certainly don't want to increase your size, but you definitely don't want to keep trading the same size. So when things are working, you step it up, and when things are not working, you bring it down. Well, and I've said this many times, but some of you haven't heard it before. The thing about when you ramp up when you're doing well and you scale back when you're not doing well, it may be frustrating when you get into a whipsaw environment and you start scaling up and then you get hit with a few losses, and then so you scale back down and then your smaller trades win, and then you scale back up and your winning trades lose, and you feel like, you know, this is not smart. I'm winning small and I'm losing big. Well, yes, but you're at 2-to-1, so that will help a lot of that. But the real thing is that you'll never, ever make a lot of money if you're not willing to scale up when you're doing well, because you'll just sell into a really good market. And certainly, if you don't scale back when you're doing poorly, you'll definitely hold or buy into a bear market, and you'll end up with with certainty a big loss. So when you scale up when you're doing well and you scale down when you're not doing well, you guarantee yourself to be trading large when you're doing your best and small when you're doing your worst. So now, once we get some of these names in the portfolio, at some point we're going to get loaded up where all the slots are going to be filled. So how do you add new positions? That's the next question. Well, what I do is I use forced displacement, and I do basically what I did in the beginning. If I have my slots and they're all filled, and then maybe I get a stock that either stops me out, or better yet, I get to a profit and I take a profit and a new slot opens up. Well, now I just go back to the same thing I did before and go back to my list and see what stock is busting out first. And that stock now goes back into my portfolio. So one comes out, maybe this, like I said, this is at a loss, and now I have an open slot. Now a new stock sets up, I'm going to add that right back, and I just go right back to the same thing that I did originally, which was used forced displacement and buy an order of breakout in order of setup. Now, let's say I'm loaded up and I start getting knocked out and nothing sets up, but I get stopped, and I get myself knocked out of everything. And then some stocks start setting up again. I'm not going to just rush right back in and go trading the same size that I just was trading. I'm going to go right back to the beginning, and I'm going to start all over, smaller. If it works out, a little bigger, a little bigger, a little bigger, and I'm going to pyramid right back in with my either number of positions or my total exposure. So again, I'm just going to revert. All the stuff that I'm showing you is all just a rinse and repeat. That's all it is. You just start all over again, and you go right back to the beginning and cycle it all over again. So that it's very important that you understand that if things aren't working in your trading and you're getting stopped a bunch of times in a row, you definitely want to get on the brake a little bit and ride the brake. It doesn't mean you just completely stop, but again, just lower your exposure. Now, I want to show a few. We got into a bunch of this at the Master Trader program, and each year we get a little deeper into it. I think next year we're going to even get more advanced in some of these techniques for positioning and selling around positions or trading around positions and money management techniques. But we're going to go over some very basic things today. First of all, sometimes you're lucky enough, you get into a stock and here's the setup. Stock breaks out, you have your stop set, and very quickly it just runs straight up. And you get yourself at a point where you're at an indecision where I'm up, say 20% in a few days. What do I do here? Well, first of all, as I said many times, selling half is a win-win situation. And I'm going to show you how to sell half and also use that as a money management technique. So let's say, for instance, in this first example, the stock breaks out, you get yourself at a really good gain right away. Well, the first thing I do is I usually take a little off the table and cushion myself a bit. And that makes it, if I go all the way back down and I take out my stop, I make some money on it usually, or if this gain is equal to my stop, I would break even. So I basically free roll the trade at that point. But what I try to do is I try to let the stock come in and go through what I call a natural reaction. And once it goes through a natural reaction, a few days, sometimes 4, 5, 6 days, 8 days, Could be a little bit longer, a little less. Sometimes it's just 2 days. I want to see if the stock can very quickly go back up to new high ground and volume can come back into the stock. If it can, then I try to hold it for even a bigger move, and I might even add back my position once I go through the natural reaction, I break back into new high ground. But the one thing that I definitely will do is I will move my stop up to break even at that point. Once I get the pullback and the recovery high, I'm almost always going to move the stop up to break even. So now, again, I've nailed down the first half. I'm free rolling the second half, and it's showing me that it's taken out this high, and this is indeed just a natural reaction. It wasn't abnormal what took place. And I'm usually going to hold that and try to then go through another natural reaction, or if it really should accelerate, I'll sell right into that. Now, you can also add back your position on what I would call adjacent setups or subsequent setups, or sometimes the setup takes place within the setup. So for instance, and we, of course, and again, we've gone through, you're welcome, Anton. This here is a situation where we're coming off of what we call the cheat, and the stock is making the turn. So here, we buy our position here, right? And we set our stop, and as it runs up, it pulls in, it goes through that natural reaction, and now maybe it gets a little ahead of itself, and you start coming up to that old high where you should be building a handle. Knowing that, this is an area where you're likely to pull in a little bit, and you might have to go through some time, the marks of time, to build this handle. You may have gotten in on a low cheat area, and this represents a pretty good gain. Maybe this is 10 or 12% or 15% gain. So you sell part of your position, and if it resets, then you add it back. As it comes out of that new setup, you add it back. This is trading around your position. And what you can do is you take this stop here that you moved up to break even. When you took out this high here and you moved up, you moved your stop to break even, and now on the new position, what you would look at this, if you were just going into it as a new trade, you would set your stop, but then you make that stop the stop on your first half. So your back half and your first half, and what happens is now this stop becomes an acceptable stop on your new position, but it becomes a backstop on your old position, and it actually works as sort of a trailing stop or locks in that portion of the gain. Now, let me show you how this works, because I did this with Ford, and I'm going to zoom up on this actually. So this is how I traded Ford. I went into stock here. This isn't the most recent Ford. This is a little while back. I think it was 2010 maybe. I came in here, and as the stock ran up, you'll see it pulls in for just 1, 2, 3 days, and then right back into new high ground. That is a natural reaction, and here's your tennis ball action, okay? Now, at this point, once I take out this high, I move my stop to break even. I definitely am going to move my stop up at least somewhat. If I'm at a 8% stop, I'm going to move it to 4. Most likely I'm going to move it to break even. I almost always move it to break even, especially if this gain is near my historic average gain. So let's just say I normally average 12%, and this represents a 13 or 14% gain at this point. I'm definitely moving to break even now. So now the stock ran up here, and I sold. I sold some of this. I sold into this rally, and we had 1, 2, 3, 4, 5, 6, with 7 up days in a row after we had run up, pulled in, and ran up. And very often you'll get a short-term exhaustion if you run up 7, 8, or 10 out of 12 days in a row, and stocks are getting extended. So I take off some of my position here, and now I'm at break even, so I'm free rolling the second half. But the stock goes through this basing period, and it sets up very nicely. And I actually have the buy point here, but I actually bought it over here. I don't know why I have this, but I actually bought it right here off this little cheat area. And as a matter of fact, I should have added here, and I didn't. This is where it's set up really nicely, and this would have been an add point, but I didn't add. I just bought it back here. I put my original position back here, and then if you look at a chart of Ford, you'll see that this went up some more, and I ended up taking another a profit there. But what I did was, now as I took this stop and I moved it up to here, so my original position has this very tight stop, and my old position now is backstopped. So I guaranteed myself that gain, and I stopped myself on the new position. Now, the way this works is basically averaging up your position without adding additional risk. And I'll try to break this down for you and show you exactly how this can work with some numbers. So your first buy is here. So let's say you buy 1,000 shares at $16.50 right here, right? And you break out and you run up here. And now, and this, as a matter of fact, is we're not selling any of the position. This is actually holding the position, and I'm just pyramiding now. This is what we call the add and reduce. So we're at a profit, but the stock sets up and resets an additional buy point. And at this point, we've got another stop that we find that it's half of this original stop. It's only a 3% stop. So I have 1,000 shares with $1,000 risk. I bought here at $16.50. I set a 6% stop. That's a dollar stop. So I have $1,000 risk. Once I run up here and I reset, I now, as this stock breaks out at $17.50, I now have a dollar profit. But if I set a 50-cent stop, that brings it down to $17. So if I get knocked out here, I'm going to lose $500 on this position here, but I'm going to lock in $500 on this trade here. So what I've done is I've cinched up my stop, and I've moved to 2,000 shares with zero risk, because this gain is helping finance this risk. Now, I'll generally do this in a situation where the risk is getting tighter. The situation is actually improving. Now, you could play around with this stuff. There's a lot of ways that you can move in and out of names and pyramid, and this isn't the only way. There's lots of things that you can do mathematically, and this is really all comes down to math and risk and technical stops and percentage stops and sort of finding a happy medium between them. But I'm not doing this on a stock that's running away. Remember, this is all still within the base that the stock is setting up, and then it's actually improving. Let me show you an example of how I did that. So this is Red Robin Burgers. Now, they had an earnings gap. The stock gapped up real strong, followed through, and then pulled in, undercut this gap. And I felt like this was a good low-risk trade after the earnings, because if it shouldn't have came in at this point. If it really fell apart, that would be very abnormal considering this big earnings gap. So I originally bought it right here, coming out of this little low pivot. We call this a power pivot or a low cheat. So it comes out of there, and then it runs up, and you see it actually tightens up even more, and it sets up this cup with handle. So now this is basically a setup adjacent to the setup. This was early in the setup, and I got in, and I've now lowered my average price if I buy more up here. So what happened was when this broke out, I just added to my position. I actually doubled up on my position, but I set a tighter stop right here, which I backstopped this gain, and that was a stop on this gain. So they sort of washed each other out. The stock, you see, obviously it pulled in here and it didn't work out, and then it fell off here. But I lost almost nothing. It was close to a break-even trade, and I increased my size. But see, I'm increasing my size on the backs of a gain. See, I'm not doing what most people do. Most people, what they do is they buy it here, they buy it over here, and then it comes off and they're at a loss, and then they double up. And then they wonder why they get into all kinds of trouble. And this is what takes place. So if I didn't stop out of this, I would have ended up at a very big loss. So I took a break even, and I was able. Now, here's the thing, though. If this turned out to be a winning trade, I'm pyramiding my size. So do you see how I'm going to make a big gain if I'm pyramiding into this? And I'm trying to build a big position in here. I'm trying to get some size on. But what I don't want to do is I don't want to increase my size with my risk. That's one for one. I want to do just the opposite. I want to always keep my reward at a ratio above my risk. So I'm always trying to figure out a way that I can increase my reward side and increase my exposure, but not increase my risk too much. So this is a way that you can use this. Now, we also had a question about adding to a position, and I forget who it was. I know you asked a question, and Bob told me to address it, and that was that you were thinking that when I go 6% and then 12% and then 25%, that was in one stock. Those are in separate stocks. I'm going into maybe one name, and then if that works out, I might bump my trading on the next name and start bumping it up. But when I'm going to average into or pyramid into the same name, I'm not going to do it just because the stock goes up. For instance, here's a situation. You break out of this pivot point. Let's call this high area here with a line. This is the breakout point. So right here, I start to buy it, right? Well, I'm not going to just buy it just because it keeps going up and it's higher. But if we pull back orderly, and we set up a pullback buy, and it starts to move back up, I might add right here. Okay, now that may seem like the same thing as buying it up a little bit more on the next day, but I've let it pull in a little bit, and now it's starting to move back up. And if it sets up again or sets up some type of pivot, even over here, you'll see as it comes up and then it tightens up here, right here, it starts to break out into new highs, and it tightens up, it goes inside, then it breaks out into new highs. I may add at these points, but I'm not adding simply because the stock is up. I'm adding because the stock is set up again, and the setup is at or above where I already purchased it. It's, you know, it might be a hair below, but I'm not going to buy this stock and then it pulls in and I'm sitting at a huge loss and I'm going to start buying more of it. Even today with the Facebook situation, I'm at a loss, and I didn't sit with the same size position. I held into earnings, but I pulled the position back. Again, if I was at a gain and we were up 10 or 15% on Facebook, I probably would have just held the whole position. So you see, I'm letting the gain finance the risk, and when the risk is higher, I'm going to adjust for that. It's very conservative. It seems like it may be too conservative when things are working out for you, but I can assure you when things turn against you, you will want to have that conservative approach, and it is a guarantee that things will turn against you. Now, here's this most recent trade, and this is EVC. Now, this is a situation, if the market was really, I thought, was healthy here, and we were coming out of a correction, and this was maybe one of the first stocks to be breaking out here, I would definitely be looking to add to my position. Once it breaks out here, this is where I start taking my position. It runs up a few days. This actually ran up 10%, just this little tiny time frame because it's a low price stock. But I would definitely be looking to, on this pullback, 1, 2, 3, and now would be looking to, on this pullback, 1, 2, 3, and now with some support here around the lows, and I would be looking, as soon as we move above this high and start getting above this high, I'd start adding to my position. I'd pyramid into that. That's a pullback buy setup, and I would just move back into some more of that position. And certainly if I happen to just look to scalp it and I got out and took a 10% or 12% profit, it pulls in here and it sets a pullback buy, I'd probably just go right back in it if I wanted to trade around the position. Or you could, of course, do the other thing that I talked about where you sell half of it, and then as it resets, you add your half back. Okay, Ralph's asking, do you add the same size positions or smaller positions? Are you referring to if I'm adding here, or are you referring to in the same trade, this example right here, Ralph? I think that's what you're referring to. Yeah, in the same trade. Well, it depends. I mean, if I take a full-size position originally, then of course if I added, I'd have to be going overweight. So generally, what I'll do is I'll take a portion of my position, and I might double up on the position if I add to it, and start building into a full position. I'm big on kind of going in at a smaller position than I might normally go in until things are working. Once things are working, then I go in full bore. I mean, I'm not wasting any time. I go right in a full position. Once I have some traction and I see things are working and I feel the market's popping right, and it's like being in, playing pool. You start running racks and you get that confidence. It's the same thing with trading. As soon as I feel that confidence that things are working and I see it in my results, then I just go right out and take a full position. But to answer your question, I would generally take maybe a quarter or half of my position, and then I would add and double up each time. So, for instance, I take a quarter here, and then I take a half here, and if it sets up some more, then I may double up and move to my full position. I scale into it. So that's how I would handle that. Now, here's the FIVE, which we're still in, and this is another one where you got at a very quick gain. I mean, if you're a very short-term trader, you certainly could have taken, I think we were at a 10 or 12% gain in just 3 days. So that was a nice trade in 3 days. And then you could wait for it to go through this basing, and if it resets, But we don't know if it's going to go through the spacing and reset. Some of these stocks just take off and they go to the moon. So there's no real way of knowing that. So again, the win-win situation is, if you want to take a profit on a short-term move, is to sell half. The reason why, and to move your stop to break even, the reason why is because if that stock comes back and all the way back and knocks you out, first of all, you can say, thank God I sold half. If it goes higher, you can say to yourself, thank God I held half. Either way, you're a psychological winner. And then keeping track of your psychology and keeping that intact is very, very important. You're a psychological winner either way. So, and you're free rolling your second half. If it happens to reset, I mean, if it keeps going, great. You made 10 or 12% in the first half. It goes up, if it goes 20, 30%, you made yourself a 15, 20, or 25% gain on the trade. That's a wonderful trade, swing trade. If it resets, and you might be able to add it back and end up even pyramiding it and getting more size on it. Might set up even better than it was originally. This was a very creative trade here, the one that I took, and this is what I would call an expert buy. You have to really have your analysis right, and you've got to be on these things very, very close, and if they don't work, you have to get out very quickly when you start trying to play them off the low like this. So it worked out. Now, this is a situation where it could improve. It could get even better. And if this were to tighten up here and to really, and of course, you know, if depending on the market, if the market was really shaping up, and I see a lot of stocks that are holding up, and this breaks out, I may bring my size up even bigger than I originally had. And of course, now that I've locked in a little bit of gain, I got a little bit of cushion there. Now, I like to bring things down to a very simple level and really hone it down to the most important elements so you can troubleshoot very quickly and very honestly. And what I found is that, first of all, you have to have a good strategy. If you don't have a good methodology, you're obviously in trouble. You're not going to win over time. But I'm pretty confident in my methodology. I've been doing this for 30 years, and I know what I'm doing is very sound. So knowing that and having that confidence in that strategy, and that's why you want to stick with a strategy and become an expert in it, because then you can have that confidence, and what it does is it allows you to really narrow down where the problems are. If you're having a problem trading and you're getting stopped out, there's only one of three things or three things that can be wrong. And that is, the first thing is that your criteria is flawed. Now, maybe you made an error. You have to go back, take a look, what's going on in your trading. Are you buying right? Is everything setting up correctly? If your criteria is indeed correct, and you're doing everything, you're checking everything, and it's all right, then there's only another thing that could be wrong. The market environment is not right, or you're not following your own rules. You have good rules, or you're just not following them. So trading failures only stem from two things, either faulty principles or faulty discipline. It's that simple. There's no other reason. You either follow your discipline and you have a good discipline, and the market environment may be wrong, or you just have bad principles to begin with. It's one or the other. So you want to go back and basically, you know, what I call is a tire check. You know, you check the tires, and before you go on a trip, you check the air in the tires and make sure, and wipers are working, and whatever you need to check. And the same thing with when you're having problems with your trading, just go back and do an all points check and just make sure you're doing everything right. And if you are doing everything right, don't get nervous and lose faith in your strategy and say, oh, this doesn't work anymore. No, nothing works all the time, but it's being able to recognize when the market environment's not right, and then you pull back and you minimize your risk. We did that. Now, of course, you know, earnings, we had the LOCK, and like I said, I really like the situation for several reasons, but we got knocked out of it. We got knocked out of this whole pullback. I very often buy early, even if I'm not buying into an earnings report. Very often I'll buy early and it'll set up, and that's why a re-entry is really important. Sometimes you just happen to get into a stock early and your analysis is correct, your fundamental analysis is correct, but you just maybe the technical buy point is early. We've done this in a few names now, and I do it quite often. I tend to be early a lot of times, but I'll re-enter. I'll re-enter a name. I'm not going to chase this name up here on this big gap today, but I will re-enter a name if it resets. And remember, though, holding through the earnings report could very well just end up just like this. This was the TQNT, which broke out and pulled in the day before, and this was the opposite scenario. So it's really been sort of a crapshoot with the earnings reports. It seems like about half of them are popping on the earnings, half of them are imploding on the earnings, and net you don't end up very much a winner. So that's why I'm not holding through almost any earnings. Facebook, I happen to feel strongly about, and I held it. We'll see what happens by tomorrow morning. We have until tomorrow to work that out. But it looks like we're in pretty good shape with that. So anyway, that's it. With position sizing into earnings, we very often get questions on what would you do going into earnings. I simply I'm going to never hold a big position going into a major earnings report or some type of news environment. Definitely not going to do that. So it would only be a small position at best. Do you guys have any questions? I can go back to any slides too if we want to go back to any slides, but let me give you a chance if you have any questions. Okay, Anton's asking, when you go on margin, is it when all positions are full and working, or do you use margin money to add to existing positions, buy new breakouts? I don't go on margin anymore. I don't need to use the leverage, but at one time I loved margin. And as I told some of you at the Master Trader program last week, I would buy until they called and threatened me that they were going to give a Fed call and they were going to shut me down. I just keep buying until I got a call from the brokerage house that said you got to stop. So I was a madman in the olden days when I had a small amount of money, but I knew I could recover, from $100 grand or so, and I took a big loss, 20% loss drawdown or something. But of course, later on after the years, and I'm older now, I don't take that kind of risk like I used to. But to answer your question. The one thing you have to be careful about is that if you're winning and this is where the caveat is, okay? Let me try to explain this. What I tend to do is I start off with small positions, and then it's sort of like a bell curve, and then I start ramping my position sizing up as things are working out. Then, when things are working out for an extended period of time, and I'm elated and happy and smiling and jumping up and down every day and life is great, then I start to actually bring my position sizes back down. And because now, very often your biggest hits come after your biggest wins. Your biggest losses, because you start feeling confident and you start doing crazy things, and it just is human nature. And any trader will tell you that. So you have to be careful about going on margin after an extended run. What you want to do is you want to get to the point where you are able to recognize when things are working and very quickly move up to margin. So for instance, if I see we're in a correction and I see a few names starting to set up and I buy a few and they work out, and then I buy a few more and they work out, and then a whole handful of more names set up, right then and there I'm going to step it up. I'm going to step it up. I'm not going to wait very long. Just so you know, this doesn't mean that you wait and wait and wait and wait until you have 20 trades working out. It's enough to have one or two trades that are up 6 or 7 or 8%, and then take on another one, and maybe you have another few that are up. Maybe the original one is up 10%, and you got a few up 5 or 10%, 5 or 6%. At that point, that's where you want to start really ramping up your exposure and going to fully invest it and moving it up. Now, if things don't work out, you start getting hit, you come right back in and you pull the exposure back down. You might have to do that a few times when you come out of a bear market, because sometimes you just don't get it right. And the market looks like it's bottoming, and you get a few head fakes, so you pull back. But eventually you'll get it right, and you'll pyramid yourself up. So that's how I do it. When I used to go on margin. Let's see. Kyle's asking, when you go from cash to fully invested with a smaller account, how did you decide whether to initially use a shotgun approach versus a concentrated approach on the first or second round of buys? Okay, you're saying I'm talking about periods before you've been able to justify moving to full exposure. Well, I'll tell you. First of all, when I was trading a smaller account, I always tried to be concentrated. I very seldom ever used a shotgun approach. And you're not going to make big gains by being diversified, and that's a fact. You're going to need to be concentrated. So my shotgun approach, as you call it, is only in the is with pilot buys. And we're talking shotgun. A shotgun shell. I don't know how many pellets it has, but it definitely doesn't have 4 or 8 pellets. It's got several hundred pellets. So we're talking about a double lot here. If we're talking shotguns, there's just a few pellets in this shotgun shell, as far as I'm concerned. So I might, my shotgun might be 4 smaller positions, or 4, 5, or 6 smaller positions. But again, once that starts working, I'm going to try to get concentrated. Let me explain something to you. Also, being concentrated is actually less risky, because you really stay attentive to those positions because you have more on the line. And again, if you're setting a 5% stop on a 50% position, it's the same exact thing as you setting a 5% stop on 8 quarter positions. There's no difference. It's the exact same thing. Okay. So or if you had 8 6.25% positions, you set a 5% stop on all of them. There's no you're not going to lose any more money than if you bought 150% position and set a 5% stop on it. Same exact risk. However, you do have concentration risk, because if that one stock happens to gap open, that's your risk. But if you're diversifying among 4, 5, 6 names, even if one stock really gets hit and it opens down 20%, you're still talking about a 5% loss of your equity. You're not gonna suffer. The problem that you will suffer when you're concentrated is if you don't be careful and not step up your exposure when you're doing well, because then if you start taking a bunch of losses being concentrated, they'll add up. So that's why, again, don't be afraid to take big positions, but don't take a lot of positions or a lot of exposure unless things are working out for you. Let's see. Mike's asking, on taking half the gain, do you consider the remaining position a new position, or do you think of it as the entire trade as one trade still open until you sell the second half? Okay, I think that's a great question. So let's go and look at a example. All right. Well, now I think of, if I set my stop, like here's my initial position, right? And I sell part of it up here, and then I go through this base building and it breaks out. This is basically a new base breakout, but what I've done is I'm sort of thinking of this as 2 positions, but I'm treating them as one. I'm setting my whole stop here, but what that's accomplishing is that is locking in this profit. I'm just setting a backstop on this half, and then I'm setting an initial stop on this half. So although they are 2 different positions, I'm treating them with one stop. So I may now, if this runs up, I might do the whole thing all over again. Sell half and try to go through another base building period. And if it's natural reactions and then it sets up and goes back, I'll add back again. So you could trade around the positions back and forth. And whether you want to call them 1 position, 2 positions, I think that's semantics. The more important thing is to protect your gains. If you have a gain, you don't want to let that whole gain slip and turn into a loss. If you sell some, you move your stop up to break even, and you protect your line, and of course you've guaranteed yourself some profit. If it resets up, you move your stop, because now this stock should stand on its own legs here. This new setup should hold. You're not going to put a stop way down here now. This new setup is now breaking out, and this will fail. And if this new base fails, well, then there's no reason why you shouldn't be applying that to the original trade as a backstop. I hope that answers the question. I'm not sure if it made enough sense. David's asking, is your win percentage better than 50% on the add-on trades when your last trade was a winner? I can't answer that with accuracy. I don't know for sure. I would be guessing. But my trades, regardless of where I trade them from, have about the same batting average. And that's because I'm never taking really bad trades. I mean, if I am and I'm stretching, I might stretch on a few trades, but I don't stretch very much. I'm waiting for the setups. So for instance, on this particular, and let me just go back here. This setup right here, as it breaks out, this setup is pretty much just as good as this setup. And if I went back and did, 500 of these and 500 of these, I can assure you that the batting average is going to be very close because they're both constructive, proper buy points. So that the main thing is to don't worry about that. Worry about don't worry. Be concerned with making sure that every buy is a good buy. And like I said before, and I've said this many times, the best way to trade is to, each time you go into a trade, ask yourself this. Say, if I only had 10 trades to make in the entire year, just imagine that your brokerage account would only allow you to make 10 trades. And once you made 10 trades, you had to wait until 1 year elapsed before you could make another trade. You had 10 trades to make per 12 months. How careful would you be about making a trade? I'll bet you your buy points would get a lot better and your accuracy would improve because it would be necessity is the mother of invention. You'd have to get your timing really down. That's sort of how I try to think when I go into a trade. I try to say to myself, if this was the only trade that I got to make, would I take it? And if the answer is not yes, then I might position size smaller. I realize that I'm not going into an optimal situation. So I want optimal situations. The problem with that is that people want action, and they can't wait for those optimal situations because, one, they don't have the confidence that there'll be more of them. They always, traders seem to think that this is the last opportunity I'm ever going to have, and they don't understand that you'll make it all up if you just protect your account and you don't lose. You'd be amazed at how much time you could let go by and do nothing and still make lots of money. Losses are what cause bad performance, not sitting in cash, which is against popular belief. Sitting in cash does not cause you to not perform well. Now, for a mutual fund, yes, sitting in cash will cause a big problem because they can't just ramp up and go right into a stock and be off to the races, and they can't be concentrated. So they can't make up lost ground. They're tied by being widely diversified and basically just being a little bit better, a little bit worse than the averages. But for an individual trader that's flying an F-16, you could make up the lost ground in a matter of weeks. You could make up for a whole lost year in 1 month. And you have to understand what your advantage is and how to exploit that advantage, and realize that you have a huge advantage with being small. And when I say small, I'm talking about 10, 20 million is small. That's not even big. Big is hundreds of millions of dollars, where you have to take big positions and be widely diversified. Let's see. Is it possible, Anton's asking, is it possible to get 100% returns without margin? Absolutely. Absolutely. You don't have to, you could certainly get big returns without margin. I got a lot of my big returns without margin. I didn't, some of the biggest years I had, I didn't use margin. As a matter of fact, when you go back and you look at some of my big years where I was up several 100%, I only averaged about being in the market about 50% of the time. I was actually, if you average it out throughout the year, I was 50% cash the entire year. So again, let me explain something. It's really important for you to understand. Is there any difference if you trade, you take a 25% position, and you're always in 75% cash? All right, listen to me very carefully. You're 75% in cash, you take a 25% position, and you do that 100 times in a year. So you're never, ever more than 25% invested. You always keep 75% cash. Or you buy 100 stocks all at one time. Is there any difference? Zero. There's no difference whatsoever. The difference is that, or let's say that you buy 4 stocks at a time, and you do that. You divide 100 into 4, and you do that many times, instead of buying 1 stock, but you go fully invested. The only difference is that you're fully exposed versus 1 stock at a time. But again, if you drive, I'm not making the best analogies here, but if you drive again from California to New York, whether you go straight through or you stop and go and stop and go, it takes the same amount of gas. So I don't have to be fully invested ever to make a big return. All I have, if my position sizing is 25% when I'm fully invested, it's no different. And let's just say I'm fully invested. I'll make a little bit better example. Over a year, I trade 100 trades. Now, at times I'm fully invested and I own 4 stocks, and at times I'm in full cash. But at the end of the year, I trade 100 trades. It would be no different than if I traded those same 100 trades and just did them one at a time and had 75% cash. As long as I get those 100 trades in, if my average gain is 10% and my average loss is 5%, and I trade 100 trades and I make 10% on 50 and I lose 5% on 50, then I'm the same exact winner. There's no difference whatsoever. You see, so what's important is that you're taking those trades, those good trades, and every trade you're looking at it on its own merit, and you're looking at it as that's putting money up at risk and how much you're risking for how much you can expect to return, and maintaining that and doing that as many times as you can. As long as you keep rolling that over, that's what's important. The trading is about making more than you risk and doing it as many times as you can. That's what trading is all about. Any other questions? I'm not sure if I got to everything. Hold on one second. Let me check. Yes, Mike, that's what I was saying before. Mike saying adding to positions after things are working. In my experience, by the time things are working, I'm due for a cold spell. Well, okay, here's what you got to do. First of all, you got to go back and see, is it taking you a while to ramp up your exposure? That's number one. Sometimes what happens is that you're not pulling the trigger quick enough. So you're seeing the green lights are there, but you're not ramping your exposure up fast enough, and then by the time you get the confidence to ramp, I mean, that used to happen to me too, but then I got a little more expertise, and I started to see those green lights a little bit earlier, and I'd ramp up my exposure very quickly. Now, the other thing you have to realize that is if you're in a back and forth whipsaw market, you will absolutely have that problem. And that's exactly where it becomes frustrating, and a lot of people throw in the towel on a concept like this. But you have to realize that you can't change for every market. You're not going to be able to have a different strategy and a different approach for every market du jour. You have to realize that there's some periods where you're not going to do well with your strategy, but that's the price to pay to get through the forest, to get to the other side, to get to the times that you're going to do well. You're not going to be able to be there to appreciate, to profit from the times where you're trending if you don't go through the times when you're not trending with that same approach, because you have no way of knowing that when one is or the other is going to be in force. So in this type of environment, it's definitely been much more challenging, and that's one of the reasons why this is the type of trading environment where I've been telling people to hang in there, because I realize that, as soon as things start working, you pull back in. And I pointed that out, where you're going up, you're running up 5%, then you're pulling back 5%. Then you start breaking out and stocks start moving, and you run up 5%, and then you pull back 5%. And it's this one-to-one isn't a very good reward to risk ratio, but that doesn't last forever. Let's see, you Ding, how you doing, you? You saying, I was going to ask you at the MTP, but I didn't have the time at the end. On some add-on positions from full weight to overweight, just as the overweight position is working, you tend to step back to full weight. Can you explain your thoughts on this? Yeah, well, we stopped doing weightings on the. You're probably looking in the archives and taking a look at some of the trades. One of the things that you don't get from the archives is you really can't see what my overall exposure is in the market, and we were doing weightings more to be able to show. We were doing more to be able to show continuation pivots or follow-up setups, and it was more a way to say, okay, well, here's the first setup, and then here's the second setup and a third setup. But now we're just doing them as separate trades, where if if it sets up again, I just put out a note and say this is a follow-on buy. We originally bought it here, but this is a follow-up setup. So the waiting, but to answer your question on how I would handle overweights and going to full weight and up to overweight and scaling back. First of all, an overweight position, of course, is one that is larger than you normally would trade, and usually is one that is large enough that it will cause you indigestion. That's what I would call an overweight. A position that is substantially larger than you normally would trade. When you get into that, if you want to do that and you're feeling confident and you really want to put the pedal to the floor, that's okay. But my main rules with overweight positions are, if they don't work right away, I just cut the overweight. So my risk is going to be even way tighter on the overweight. And I want to never, ever let an overweight position really start working against me, because now I'm losing way larger than I normally win, and I'm going to really hurt my overall numbers. So, and I never, ever go overweight if the trade's moving against me. I'm only going to go overweight in the direction of the trade. And what I very often will do is, if I do go overweight, and I'll trade out of the overweight on that first run up, and I'll use that to cushion my full position. So in a situation like this, let's just say I come out of here and I go overweight right away. I love this stock and I love the situation, and I go overweight and it runs up here into this first rally. I might just cut right out of the overweight and just take that real quick gain. So now I'm full weight, and we pull in here, and then we move to new high ground. We run up, and now I go to half position. And so now I've essentially nailed down more than a full position, because my overweight, maybe I was double there, so I nailed a full position here, and I'm nailing half my position here, so I nailed down a lot of profit, and now I can go through this and maybe then add back over here and go back to my full. But if I was overweight in this situation and we pulled in and we didn't immediately break out and follow through and get back to the new high ground a day or two later, and this stock just started falling back, I would just get out of my overweight right away. So that's how I handle that. Any other last questions? I think we're right at an hour, so we've hit the hour mark. I'm gonna wrap this up. Let me just give a quick synopsis. Great, I'm glad that help was helpful. Let me just give you a quick synopsis. The market, I think, is in a situation here where you got to be careful. We're either going to pull back or probably mark some time. If we do rally from here, I would definitely use it for selling, because I think it's going to really suck in the last bulls. And there's a lot of signs here that are saying that this market is getting a little dangerous at this point. The sentiment figures, we've got a lot of stocks aren't acting very well. When you start getting the key leaders like a LinkedIn and some of these past leaders here are acting a little abnormal. This is a pretty big decline here on huge volume. I didn't even really looked at this yet. Just come out here. You'll see this is some of the biggest volume we've had, since back here on this last break. And this break here it had to go through a whole resetting period. So we'll be yet to see if that is what takes place here. We also have something like a Netflix. These are some of these leaders that, this is a huge, enormous reversal on gigantic volume. We'll see if what the stock does here, but I would think that this is going to cause a problem for a little bit for this name. There's a good handful of these leaders that aren't acted too well. So at the very least, it might not be where the general market has a huge problem, or it might, but even if it doesn't, you may get some of the leading stocks to have to correct, or you get what I call a stealth correction or a stealth pullback, where you'll start to see some of the leaders start to rotate, and that's not bad. We could rotate out of some of these leaders and have some new leadership start to crop up, and I think that would actually be a positive sign, because we can't keep just buying extended stocks. Eventually you're going to put yourself in a position where you're having a problem. Something like a Coors is acted pretty good here. This was my little diagram I drew. If you remember, I talked about how it undercut this low, and we came up and it pulled back, and I was looking at, you buy it around the 20, and then as it moved through there, it sort of grew into my little diagram. I'm going to just take that out for now. Yeah. And this is holding up pretty good. I mean, I wouldn't be surprised to see this maybe come back a little bit and tighten up, and if you could break out from here. But if the market pulls in, we could get stopped out and just, we may be forced into cash here pretty soon. We're only in 1, 2, 3, 6 positions here. 5 is holding up pretty good, but I'm moving most of these stops, as you notice, to break even. Our average stop right now that has been hit is only about 3.5%. And if we got stopped out of everything at this point, we're looking at, about a 1.5 to 2% loss on everything. So we've managed the risk really well, but it is very frustrating when you're in there doing all this work and you don't make any progress. But again, if you could lose a few percent or break even when things are difficult, you're going to make a lot of money. And that's the key, to just manage the difficult times and don't get your eye on the Dow or the NASDAQ that it keeps going up. Watch the universal stocks and wait for the setup. So monitor the platform this week. Let's see what happens going forward here and how we get to the end of the week. We had a good, nice Facebook situation here. Let me just go back to it. I haven't looked at it. Now we'll see. Now it's pulling in here, so it's all wild all over the place. It looks like you'll probably get a gap tomorrow and up here and have a chance to either have it get back to maybe above where we paid or make some profit on it at some point. I'll probably backstop it at that point, because on the earnings report, if it can't hold up on the earnings report, then we probably got problems. So anyway, I'll talk to you guys again this week, maybe if not next week in the room, and monitor the platform throughout the week. All right? Bye-bye.